Raise the lot rent by $25 a month across a 100-space trailer park. Just $25. Do that, and the property you own is suddenly worth about $400,000 more almost overnight. And here is the part that should sit with you. Almost nobody moves out. They can't. It costs $5,000 to $10,000 to physically haul a mobile home somewhere else. Most of the people renting these lots don't have $5,000. So the rent goes up and the homes stay exactly where they are. Because that's the trick almost nobody understands about a trailer park. You own the land. You own the roads, the water lines, the mailboxes, but you don't own a single one of the homes. Your tenants do. They just can't afford to leave them. That inversion is the entire business, and it's made a Sam Zell company, a wave of private equity firms, and quietly Warren Buffett a great deal of money. It's also drawn a letter from a United States senator, tenant unions, and a federal lawsuit. So over the next 15 minutes we're going to run the real numbers. What it actually costs to buy a park from a $300,000 mom and pop lot to a $1 billion portfolio. Where the money truly comes from, which is not where you'd think. Why the tenants can't leave, and what that does to the math. The two ways owners still manage to lose everything. And then the person who got richest of all, who never bought a single trailer park, and wins whether any of them succeed or fail. By the end, you'll be able to look at a row of trailers and see exactly why it's one of the most profitable and most uncomfortable assets in American real estate. Let's start with the price of admission. A trailer park is, for most of its history, the asset nobody respectable wanted, and that's exactly why the numbers work. At the bottom of the market, a small rural park, a dozen or two lots, gravel roads. One owner who's run it for 30 years can trade for a few $100,000. 2, $300,000 for the whole thing. You are not buying buildings. You are buying dirt with hookups on it. Move up a tier and a stabilized park in a decent market 50 to 100 occupied lots, paved roads, city utilities runs into the low millions. And at the top, the REIT-grade communities, the ones with a clubhouse and a pool and a waiting list, change hands for tens of millions. The way the industry prices it isn't really by the park. It's by the lot. Investors will quote you a price per occupied lot, sometimes $15,000, sometimes $50,000, sometimes more in a hot metro because the lot is the unit that produces rent. The home on it isn't your problem, it's the tenants. Now, why was this asset so cheap for so long? Because it looks like a headache. It's low status. Banks were slow to lend on it. And roughly 85 to 90% of these parks, by industry estimates, are still owned by the original mom and pop operators, people who set the rent in 2009 and never touched it again. That fragmentation is the opportunity. Thousands of parks run casually. Underpriced on purpose by owners who felt bad raising the rent on their neighbors. To a spreadsheet, that's not a community. That's money left on the table. To understand why buyers were willing to line up for the ugliest asset in real estate, you have to see where the money actually comes from. Here is the number that changes everything. In a mobile home park, the operating expenses run about 35 to 45% of revenue. In an apartment building, they run 50 to 65%. That gap is the whole game. And the reason for it is that inversion from the top of the video. When you own an apartment, you own the apartments. You fix the roofs. You replace the appliances. You repaint between tenants, you eat the vacancy, you pay to turn every unit. In a trailer park, the tenant owns the home. They fix their own roof. They mow their own patch. When they leave which, as we'll see, they almost never do, the home doesn't leave with them, and it isn't your cost to turn. You are running a business with almost no product to maintain. You maintain the roads and the water lines and not much else. The tenants maintain everything that would normally bankrupt a landlord. So the margins are higher, And strangely, the price is lower. Mobile home parks trade at cap rates that yield a buyer demands roughly 1 to 3 points higher than comparable apartments. In plain terms, you pay less for each dollar of income than you would on almost any other kind of real estate. And then here is the supply. Almost no town in America will approve a new trailer park. Nobody wants one built near them, the zoning fights are brutal, and so the number of parks, somewhere around 43 to 44,000 nationwide, is essentially frozen. Some get bulldozed for redevelopment. Practically none get built. You are buying into a business where new competition is, by policy, nearly impossible. Higher margins, lower price, no new supply. That combination is what turned the asset nobody wanted into the asset everybody suddenly wanted. And once the professionals arrived, they brought levers the mom and pop owner never pulled. The cleanest one is utilities. A lot of old parks paid the water bill for the whole property out of one master meter. So the new owner installs individual submeters, a few hundred to a few $1,000s a lot, and starts billing each home for its own water. Almost overnight, residents cut their water use 20 to 30%, because now they're paying for it. The owner's biggest variable cost gets handed to the tenants, and the park's net income jumps. Which brings us back to that opening number, and I want to show you the actual math, because it's the engine of everything that follows. Take a 100-lot park, raise the lot rent by $25 a month. That's $300 a year per lot, times 100 lots, $30,000 a year in new income, and because you own the home nothing, almost all of it drops to the bottom line. Now value the park the way buyers do at a 7% cap rate. $30,000 of income divided by 7% is about $428,000 of added value. A $25 rent increase. $400,000 in value. That is why, when a park changes hands, the new owner's very first move is almost always to raise the rent. Which raises the obvious question. If you raise the rent, why doesn't everybody just leave? This is the center of the whole business, and it's the part the investing videos tend to say quietly and the news pieces say loudly. So let's just say it plainly. They don't leave because they can't. A mobile home is mobile in name only. Moving a single wide might cost $5,000 to $8,000. A double wide, $10,000 to $13,000. A full move with setup and permits can run past $20,000. And a lot of older homes simply can't survive the trip the frame flexes, the walls crack, and you arrive with a pile of scrap. So picture the tenant. They own their home. It might be worth $30,000 or $40,000. Moving it costs a quarter of that, if it can be moved at all, and they'd need somewhere to move it to in a market where no new parks are being built. The home they own is bolted to land they don't. Economists have a dry phrase for this. The rest of us would just call it stuck. And the numbers show it. Tenant turnover in mobile home parks is reported at around 2% a year. In apartments, it's closer to 47%. That is not a rounding difference a park owner deals with roughly 1/20th the turnover of an apartment landlord. Almost no vacancy. Almost no marketing. Almost no cost to fill a lot because the lot never empties. Now put that next to who actually lives there. The median household income in these communities is around $35,000 a year. About a quarter of the residents are over 60. This is, by a wide margin, the largest source of unsubsidized affordable housing in the country, more than 20 million Americans. And this is the honest core of the story, so I am not going to dress it up. The pricing power that makes a trailer park such a good investment is not a reward for building housing, or improving anything, or taking a clever risk. It comes from one fact: the people living there can't afford to leave. The rent can go up and up and up, and the only thing keeping it in check is how much an older resident on $35,000 a year can absorb before something breaks. The returns aren't a reward. They're a toll collected from people who can't afford to leave. Every winner in this business is standing on that sentence. which is also why the business is more fragile than the spreadsheet admits. Because there are two ways to still lose, and the first one is that you push the toll too hard. Meet the cautionary tale Havenpark Communities, a Utah-based operator of more than 80 manufactured housing communities. They ran the playbook exactly by the sleepy park, raised the rent toward market. And in 2019 they became national news for it, when residents at their Iowa parks were hit with lot rent increases reported between 24% and 69%. It drew a public letter from Senator Elizabeth Warren calling the practices predatory. And here is what the spreadsheet missed. The tenants couldn't leave, so instead, they organized. They formed associations. They went to the press. They pushed for rent increase moratoriums. And the deferred maintenance the model quietly runs on came due in public at one Iowa park. The water repeatedly tested unsafe for manganese, while residents reported the ground literally eroding under their homes as the rent kept climbing. That's the ceiling. The same immobility that lets you raise rent with impunity means your tenants have nowhere to go and nothing to lose by fighting you. And poor and elderly people squeezed out of the last affordable housing in America is a story that writes itself into Senate letters, into rent control bills, into lawsuits. Pricing power on a captive base has a political limit, and the owners who ignore it don't lose on the pro forma. They lose to regulation and reputation. The second way to lose is quieter and more financial. During the cheap money years of 2020 and 2021, institutional buyers surged up to roughly a quarter of all park purchases, and they bid prices up, paying more per dollar of income on the promise that they'd raise rents and refinance at a gain. Then two things broke that trade at once. Interest rates rose, so the cheap debt they used got expensive and values fell, leaving the operators who bought at the top underwater before the rent hikes fully landed. And the very levers the whole thesis depended on started getting legislated away. Minnesota banned a common utility billing method. An Ohio court moved to regulate park submetering companies as utilities. A United States senator opened a probe into investment groups buying up trailer parks. And a federal class action now alleges that dozens of park owners used the same software to coordinate to fix lot rents across the country. The math that made trailer parks a billionaire's strategy is the same math that painted a target on them. So after all of that, the captive tenants, the political ceiling, the leverage risk, who actually walks away rich? The obvious answer is the big operators, and they've done extraordinarily well. Equity Lifestyle Properties, built by the late Sam Zell, is the largest owner of manufactured home communities in the country, around 200 properties. More than 73,000 lots, an average lot rent of about $860, and occupancy near 95%. It was, for years, described as Zell's single most profitable venture. Below that sit operators like Frank Rolfe and Dave Reynolds, who rode the same math to one of the largest private portfolios in the country, and then got rich a second time selling mobile home university boot camps, teaching everyone else the playbook. In this format, tier is always someone who gets rich teaching the gold rush. But the person who built the best machine never bought the dirt at all. Follow Warren Buffett. Berkshire Hathaway owns Clayton Homes, the largest builder of manufactured homes in America. More than 40% of the market, around $11 billion in revenue. So Berkshire builds the home. But Berkshire also owns the two biggest mobile home lenders in the country. So when a low-income buyer moves into a park lot and finances a home to put on it, here is a very good chance Berkshire built that home and Berkshire wrote the loan at interest rates reported to run into the low double digits. Think about what that stacks. The tenant owns the home and takes on the debt. The park operator owns the dirt and takes on the risk, the tenant complaints, the rate exposure, the senator's letter. And Berkshire sits one full layer above all of it, collecting the margin on the house and the interest on the loan. Whether that particular park thrives, gets sold, hikes its rent, or burns to the ground. That's the purest version of this channel's recurring lesson. The people closest to the asset the residents own the thing and carry the weight. And the real money is made by whoever is standing one layer up, owning the part nobody's looking at. So should you buy a trailer park? The math is genuinely unusually good. Low expenses, frozen supply, tenants who almost never leave. But every dollar of that yield rests on the same uncomfortable fact, and I'd rather you see it clearly than pretend it away. The trailer was never the business. The dirt underneath it was. And the reason the numbers work so well is that the people living on it can't afford to go anywhere else. The returns aren't a reward for housing anyone. They're a toll on people who can't leave. If you want to see the other side of this, the businesses that make their money when you don't show up, the gym video is right there. And it's the same trick in a nicer building. I'll see you in that one.